Welcome to UBS On Air. I'm Dan Cassidy, and thank you for joining us for this edition of the How Should I Be Positioned podcast series. As you know, this is a conversation which explores the UBS House View recommendations versus those of our colleagues from our partner asset management firms. Let's get started with today's face-off. Joining us from the UBS Chief Investment Office is Head of Asset Allocation Americas, Jason Draho. From the partner side, we are excited to welcome back Jeff Kilburg, the founder, Chief Executive Officer of KKM Financial. Jeff has been on with us many times prior, and as you know, Jeff's career in the markets has spanned over 20 years, and Jeff is also a frequent contributor on CNBC. So, Jason and Jeff, it's great to be with you both this morning, and thank you for joining us.
It's good to be here, Dan. Thank you for having us.
Thanks, Daniel. Wonderful to be here.
So, Jason and Jeff, I know there are many topics we want to hit on throughout the course of our conversation, though perhaps as we typically do on this podcast, we can begin with the elevator question. Jeff, in about 1 minute, 60 seconds, how would you summarize your macro, not necessarily your micro, but your macro asset allocation outlook?
Well, I think it's been really interesting, Daniel, and try and keep it under a minute. What we have seen is just a historic drop, and no matter what metric you want to utilize, this has been the fastest ever. If it's 10% into a correction, 20% into a bear market, 35% drop, this is the fastest we've seen, and we can attribute that to, by and large, in my mind, in my opinion, the algorithm certainly sped up the selling pressure and it exaggerated this downdraft. But what's been really interesting is that asset allocation component you talked about. So near term, I think there's a tremendous opportunity, and I'll let Jason expand upon that, but in our view, the tremendous opportunity is to see what has appreciated and what has diminished. Your target allocations that you had to equities certainly has diminished, and certainly the fixed income component has appreciated. So we look at rebalancing, we look at tax loss harvesting, we look at this moment in time. I know we're ending the quarter today, but we look at this moment in time and to embrace this volatility, and as we've seen a nice bounce here, I think there's an opportunity as we move the S&P 500 back up nearly 22%. I think this is the moment in time to understand the near-term reaction, but the full-year outlook. And that full-year outlook, I'm pretty optimistic, Daniel.
Jason, what about your thoughts as per the UBS House View?
So I think near term, I'd say the outlook is still highly uncertain because so much depends on the virus itself and the measures to contain it. There's still signs that things are escalating in the U.S. A little bit of kind of at the margin, you could say there's signs of progress and kind of bending the curve. But I think it really is very much kind of day to day, and it will probably be another almost 10 days to 2 weeks before we really see signs of the kind of social distancing restrictions put into place, now more broadly across the country, start to really have a kind of a positive impact. And then how comfortable can sort of the officials be to start to alleviate some of these measures starting perhaps in May. So I think because of that, I think there's just a lot of uncertainty, which means for the markets, which have I think are kind of priced for that sort of scenario near term of things kind of starting to get back to normal gradually, beginning in kind of maybe later in May, later the second quarter. Any disruption to that, that's more to the downside, would be kind of a little more negative, at least in the next few weeks. Taking the full year, and frankly, even kind of thinking about like more almost like a 1 to 3 year horizon, I think the outlook starts to become better in that case. For the year, we're likely to have a bounce back in the second half of economic growth, just because things do start to lift in terms of the restrictive measures. There's significant policy stimulus, which will, the benefits will probably really materialize more later on in the second quarter into the second half of this year. So I think the idea of a U-shaped recovery still looks reasonable. Then just from a market's perspective, what would you want to kind of be allocating to right now? Given the extreme sort of uncertainty in the near term, I think on a broad asset class basis, kind of credit looks a little more attractive than equities, just because I think it's pricing for more worse scenarios than equity markets are. Longer term, though, if you're thinking 1, 2, 3, 4 years, equity valuations have come down a lot, and when you compare them relative to fixed income, especially bonds, the relative attractiveness is as good now as it's been in a decade. So for investors who do have a longer term horizon, we think most should have that this is not a bad time to be thinking about increasing your equity allocation in some more longevity type of strategies.
If I could just add on one thing there, I think Jason really brings up a great point, and it's the measuring stick. How do we gauge the actual coronavirus COVID-19? And we're trying to utilize different templates from different countries with different demographics. So it's very challenging. That presents a large headwind, and the models are different I'm in Chicago. The models are different in Chicago than they are in New York. So that is the biggest challenge I think active investors are really trying to understand. Is the template that we're utilizing predicated on China's outcome, predicated on South Korea, predicated on Italy? And I think we're finding out day by day how that's evolving. So, of course, we want to see corona case reporting diminish. We want to see those actual new cases go down before we get a better understanding. But what is really interesting about the opportunity in the markets is that it's such an acute reaction. The market just on February 19th was at all-time highs, nearly 3,400 in the S&P 500. Just, over 20 days later, we were dipping under 2,200. So we've never seen an acute reaction in this manner, and it is breathtaking. It was very surprising, very shocking, and I think right here inside of this carnage, I think we're really trying to understand that opportunity, but that opportunity is certainly staring right at the fact that we need to understand, are the measurement sticks, are the gauges that we're utilizing accurate and appropriate for taking some type of outlook, if it's 1 month, 3 months, or 3 years.
Yeah, and Jeff, to your point, it's very difficult to measure the longer-term impact and implications of COVID-19 to not only the U.S. economy but the global economy, especially considering we're learning something new about this virus spread on a daily basis. It's constantly evolving. We're receiving new data. I do want to touch on asset allocation a bit. Before we do so, maybe we can spend a few moments touching on a couple of macro topics. I do want to dive a bit more into the U.S. and global economy. And Jeff, I know we spoke about this in conversations, one of which that dated a few weeks back, but there were signs of improvement prior to COVID-19 becoming a major global health issue, of improvements in the global and U.S. economies. How do you assess the domestic economic impact of the virus, though, U.S. specific?
Well, you bring up a great point, and yes, we did snap, consecutive quarters of earnings recession. We were excited about Q1, and now all of a sudden we have this curveball. We're trying to how to move forward with this curveball. And Q2 growth expectations are certainly being revised lower, and there's more and more data that we're trying to implement to measure that and assess that. But some analysts on the street, Daniel, have revised second quarter U.S. growth to be lowered on an annualized basis of minus 34%. We're seeing some people predict unemployment to potentially soar up to 15, even 20%. So I believe the shocking data that we're about to endure, I think the market is fairly well prepared for it. It's going to be alarming to see some of this data. We saw, some confidence numbers come out earlier this morning, but I think this is the additional opportunity inside of this data. There's not going to be a surprise that Q2 is going to be a catastrophic quarter, but it's the Q3, and that's one of the conversations I don't think enough people are talking about, is what does Q3 look like? Is it going to be 15 or 20% to the positive side? Is it going to be that much of a snapback? And it goes back to Jason's point, are we going to see more of a U shape or potentially a V shape? Some people are throwing more letters out there. They're talking about a W shape, but I'm pretty confident that Q3 and all the stimulus and all the moving components we can probably hit later coming out of the Fed, that is really offsetting, but it is a challenge. When you see the economy being shut down, we're trying to stimulate the economy to be revised and revamped. It's like two opposite charged magnets trying to be pushed together. So that is going to be relevant in the numbers, and I think we do have to prepare for those Q2 growth expectations to be severely revised to the downside.
Jason, what about your thoughts? So trying to assess the economy right now is a challenge because things have happened so rapidly. There's no real precedent to basically have government officials tell businesses to stop functioning. So you have this sort of start and stop in economic activity that kind of mirrors the drop-off in equity markets. You can just look at a chart and see how quickly equity sold off. In some ways, economic activity has taken kind of a comparable hit. Whether it's like on restaurants, if you're in New York City, they've closed entirely and they're doing some takeout, but that's gone from 100% to maybe 20% of normal activity. Movie theaters are closed. So there's a difficulty in terms of trying to assess the data, which is why the forecast for the second quarter range from bad to almost truly kind of catastrophic in terms of the amount of GDP destruction in the second quarter, which should be recovered to some extent later in the year, but the magnitude is large. So there's almost a little bit of no real point in trying to exactly come up with the right forecast, but to think about, how do you track and how can we sort of assess, the damage from here and how things recover. And there's not an easy way to necessarily extrapolate the number of weeks of kind of restrictive activities on mobility, but every extra week, you can assume it's almost like knocking off perhaps like a percentage point or more of GDP. But there is a risk that it becomes sort of nonlinear, meaning that businesses can maybe hold on for 6 weeks and perhaps until early May, but if this were to continue into June, they might have to actually lay off workers. We saw some of the news yesterday in terms of major retailers laying off employees because they're just they don't think they're going to be back in business at least until May. So there is a risk of sort of this nonlinearity that kind of kicks in. But when we actually try and assess where we are, traditional sort of data points that we would look at on a month-to-month basis are kind of less relevant. We've seen that over the past couple of weeks where data has been reported for really February, and if you look at the numbers, they're actually fine because February was still okay. Even when they report for March, the numbers are going to be bad, but maybe not kind of give us a real-time indication because the situation can literally change day to day based on the case count and the restrictive measures. So one thing that we're trying to look at is to try and get a gauge of more high-frequency data that can be updated maybe weekly or even daily in some cases to see, how is activity starting to come back? Because we know things kind of shut down like in New York City. If business is shut down, we're basically at zero, so everything from here is a positive. So some basic data such as transportation or mobility measures. The TSA, I think, gives a daily or maybe a weekly update in terms of the number of flights, people going through security to be on airplanes. So as we start to look at some of those data points and if they kind of gradually improve, that's a proxy for things kind of recovering. There's measures that show rush hour traffic times, and obviously that's taken a big hit in certain major metropolitan areas. As that decline, or that starts to rise, it's a sign that sort of activity is kind of coming back to normal. So I think we have to sort of use unconventional data in this cycle or in this period of time because things change so rapidly, they change daily, and I think more traditional data points are less relevant. So it's a kind of we're kind of working with a different playbook in terms of how to assess, at least for the next few months, the outlook. And I think for the second half of the year, it's the same kind of thing where we have to kind of see how do things start to kind of recover and how quickly are they recovering to verify whether we are getting that U shape that we expect, or is it more, ends up being optimistically a V, or could we be stuck in sort of like the L shape where there's no real recovery. That's how we kind of have to assess the impact and the outlook as we go forward.
Jason, that actually leads me into a quick question, if that's okay, Daniel. But Jason,
by all means,
we see the data coming out, and yesterday there's a 93% drop via the TSA checkpoint. So you're seeing air travel really go down just to almost to zero. So that all these data points are coming in. But the one thing that asset managers like KKM or financial advisors like all the phenomenal financial advisors at UBS, they're really getting geared up for the typical earnings season. We are not going to see a typical earnings season. We've already seen a lot of the S&P 500 companies forego their forward guidance. What does that landscape look like? How do we get back to normalization of understanding the data that is presented to us in the typical earnings season? And how does an investor utilize any type of historic point to lean upon, because we've never seen a situation like this before the pandemic, or at least not in my life cycle?
That's a great question, because some of it comes down to maybe the philosophy you might take as an analyst covering it or as an investor looking at the stocks, and you say, this was kind of a one-off shock that as a result, we know the Q1 data and Q2 as well is going to be just terrible. But then when you start to kind of recover by the third and especially the fourth quarter, and the next year will be basically kind of running normally, with obviously the growth numbers off a low base will look pretty good. So you just sort of disregard this data. And we've had situations where whether it's a natural disaster or there was oftentimes in the first quarter over the past decade, there's been very significant storms where the data is weak, so people look past the data. So I think there's some issue when we look at this upcoming earnings season, whether investors might kind of dismiss the first quarter that's bad. We know they can't give guidance in the second quarter, and they might just sort of kind of discount it as much as possible. To the extent that companies can give guidance, that would be helpful, but the problem, I think, if you're a CFO or CEO of a company, realistically, if you start reporting in 3 weeks, how much more clarity will they have on when things recover? Because I think they're probably operating with no more clarity in terms of how the virus will play out and how restrictive measures will be lifted than the rest of us. So my guess is they would probably adhere to, until we have, greater certainty, we just don't want to give that guidance, which, you can either view that negatively and that, well, there's just so much uncertainty. I think that's bad for equity markets and you want to kind of take the prices down. or you kind of feed into that thesis that I said of, well, you just, there's a lot of uncertainty, it's just everyone's going to kind of kitchen sink, bad results. This is a one-off, and then moving forward, we'll kind of get back to some sort of normal. Then you're trying to figure out what is kind of normal earnings, say, starting in 2021, and then you apply sort of a normal valuation, and you kind of go from there. I think there'll be kind of two camps. The question is which one sort of kind of wins as we come into the earnings season. I think that remains to be seen.
Yeah, no, I think that's kind of our summary as well. I mean, for the longest time, for decades and upon decades, we've seen price efficiency, we've seen forward guidance, we've seen earning estimates. We've always been able to embrace those data points, but now we do see some dislocation, some price discovery. We look at some of the essential names. If it's a banking name, if it's a Disney, if it's a J&J, some of these essential names, which to your point were being indiscriminately sold. I think there's opportunity inside of this carnage, and that's where we get excited because of this dislocation of data, which we're really not going to have until Q3, until people feel confident, maybe even Q4 with some of the earnings numbers.
Yeah, there's obviously a sell-off, there's huge dispersion in performance, and so that's where if you can really kind of understand the fundamentals of the companies, and there's going to be some great opportunities for people buying. It's just obviously highly risky at this point in time.
And I do want to get both of your views on risk assets as well as fixed income, given the current environment that we're in. But to your prior points, the economic impacts are real, and they're felt across all different facets of the economy. And it's quite extraordinary to see the scope and scale of the policy responses from the White House, the Fed, which have been announced, which will be implemented. And it sounds like as of this morning, a media outlet reported that White House officials are working on additional Phase 4 stimulus measures, which may come down the pike as well. Jeff, I'll throw it out there. What are your thoughts on the current scope and scale of the policy responses we've seen from the U.S. government in efforts to support the economy and perhaps mitigate the fallout?
Well, as you know, Daniel, I don't get political on CNBC or even in UBS in studio. I typically just try to stay on the trading perspective. And what's really interesting and why I'm impressed with the Fed, the Treasury, as well as administration, I'm impressed with the sheer velocity of their response. And I think Jason can expand upon this, but what's interesting to see, they've done more in a week than our collective response to the great financial recession back in 2008. And certainly they were more prepared. Certainly the velocity of this move caught a lot of people off guard. But I think the policy response has just been sensational, and that has been the wind in the sails of the last 22% bounce off that low when we were at 2173 in the S&P 500. I do believe there's a secondary stimulus package already being floated around in the wake of the historic $2 trillion stimulus package, but the amount and sheer volume they're putting together has been impressive. But lastly, what I would say is last Monday, a week ago Monday, when the Fed came out with an unconditional, unlimited commitment, we've never seen that. That was an unconditional, unlimited commitment in perpetuity. That was the game changer. And we obviously saw that thing get digested initially on Monday, and then we started the rally Tuesday, Wednesday, Thursday, Friday. But I think that Fed response to really systematically and pragmatically go to credit, go to commercial paper, they're going one by one. I think that was just a tremendous response, an impressive response, and I think that will pay dividends as we really don't understand the true sheer carnage that the coronavirus, COVID-19, is actually going to produce to our economy.
Jason, what about your thoughts on the kinds of policy responses we've been witnessing?
Well, as Jeff mentioned, this is kind of unprecedented in terms of the speed at which it's happened. So just in the way that the hit to the economy, the hit to the markets was incredibly fast. The policy response, first by the Fed to pull out its whole kind of financial crisis playbook and implement it in a matter of basically 10 days, showed that they've kind of learned from the prior crisis how to respond very quickly. And then on the fiscal side, there was a Recovery Act that wasn't passed until I think February of 2009, so almost 4 or 5 months after the crisis really began. Now we've had already 3 packages, the most significant one last week. That was only a few weeks into this happening. So that's a positive that I think it's helped to kind of take off some of the more adverse sort of risk scenarios at least for the U.S. economy for most people. And I think in the very near term, like this week in particular, I think the key thing is to see what are some of the details of various programs that were announced. So as part of the stimulus package, the way there's around $475 billion that's been allocated to basically fund the kind of special purpose vehicles that will be going towards the Fed kind of buying corporate bonds, buying municipal bonds. And there's also a program that's going to be set up, I think it's called like the Main Street kind of lending program with the idea of helping funnel kind of credit and lending to, small and medium-sized businesses, like kind of real mom-and-pop type of operations, which I think, Treasury Secretary Mnuchin on Sunday said they'll have details for that announced by Friday. All that means that the Fed, if it's going to support these markets, it can apply essentially leverage, so it can think of it as, almost $500 billion of equity from the Treasury, and they can kind of apply leverage to that to give lending to these businesses, and that could be in the trillions of dollars. So as we get more details of the size of that, how effective it is, how much businesses take it up, the scope of the existing stimulus that's already been announced, it actually could be greater than what the headline numbers were, which on the fiscal side was roughly $2 trillion, about 10% of the economy. And then I think as time goes on, as we get a better sense of how long it's going to take for things to recover, it's a good chance by maybe say mid or later April, there could be that stimulus 4 package, which could just be additional funding. It could kind of have some time to address some of the maybe either deficiencies or issues that occurred with the stimulus 3 in terms of having to get it wrapped up so quickly. Maybe there's more effective ways to get funding out. So I think that's what I would look for in the next 2 to 3 weeks, is sort of the details of some of these plans and ensure the money is still being provided to the people who need it most, ensure that the worst case scenarios for the economy don't materialize. So I think that's what I would look for the next at least 2 to 3 weeks.
So we are entering into the final few moments of the conversation. I do want to dedicate this time to discuss some allocation views. Jeff, as it stands today, given the environment that we're in, what are your current views on risk assets, U.S. equities?
Well, I think it's really important to understand your target allocation. I think asset allocation is really testing the true risk scores. We talked to a lot of financial advisors and some of their clients who were calling back a week ago Friday on March 20th talking about raising cash. I think the test of risk scores really has come to the surface, but I think understanding the asset allocation is really presenting an opportunity to rebalance. No matter what the account, we are seeing the opportunity to diminish that exposure to fixed income, if you have the typical modern portfolio theory of 60% to equity and 40% to bonds, you've seen that 40% allocation to fixed income appreciate. So diminishing that exposure and reallocating back to the side that has obviously suffered in performance, which is the equity exposure, I think this is a moment in time to really adhere to understanding the risk score of your client, but also to be proactively doing that. And I'm not a tax loss harvesting expert. I'm not a tax professional by any means, but we are having a lot of conversations with the financial advisors and the family offices that we work with to adhere to this moment in time. Typically, the tax loss harvesting conversation or rebalancing happens in December. I think it's really prudent to have that conversation here in Q1 or in early April.
Jason, what about the views from the Chief Investment Office? Well, so I would echo what Jeff just said about kind of rebalancing and tax loss harvesting. Those are kind of proven to be, over time, very successful and consistent ways to add value to a portfolio, and they can do it in a very predictable way. I think, the average kind of 60-40 portfolio, if it was at some of that weight, back in mid-February, it probably got down at the bottom to something closer to like 52 to 48 equities versus fixed income. So just kind of reallocating back towards that, your kind of target allocation. It doesn't have to be in one fell move, but like kind of doing it, in increments perhaps of, 3-4%. Is effectively kind of like dollar cost averaging. You're buying an asset class that has gotten cheaper, and you're selling one that's got more expensive, and historically over time that tends to add value. Once you kind of get back to your target, I think that's kind of where I think we kind of recommend investors should be, especially in kind of your riskier portfolio that's kind of more for the long term. There's still enough uncertainty that it's probably not prudent to make big sort of tactical bets right now. When we think about kind of stocks, bonds, kind of credit markets, we tend to favor kind of credit asset classes in general, just because I think they're probably pricing in more dire scenarios than equities are. So they could certainly kind of do worse at this point in time. With the S&P at 2630, 2650, there's definitely a chance that they could retouch the lows, that we had just a week ago. If, for example, the earnings season isn't going well and the case situation isn't improving. So I think the most important thing is kind of make sure your portfolio is kind of, at your sort of long-term target, invested, selectively take some opportunities, but don't necessarily kind of, go for singles and doubles at most. Don't swing for home runs right now.
Yeah, and I would add one last thing, Daniel, just really quickly. I know we're on time, but it is a sector opportunity. And, one thing we're really focused inside this asset allocation rebalance, if we have some financial advisors looking to pick stocks, really focusing on the theme of essentiality. We run that portfolio Essential 40, but just sticking with a step beyond Peter Lynch's buy what you know. It's buy what you use. It's the Amazon. It's the Microsoft, the Costco's, the Intel. Some of these names are really going to hopefully have a pickup to the upside when we see markets heal, but also look at sectors. Technology continues to be the leading sector from a relative strength perspective. In healthcare actually just popped up above. We sold banks last week and actually bought into healthcare. So there's a couple sector opportunities that you need to stay with and more importantly stay away from. Look at energy down over 52% year to date. That's really a tough pill to swallow. But I just wanted to add in a couple tickers there. We do like IBB, XLK, some of those names that can kind of give a sector opportunity moving forward.
Yeah, appreciate those added insights there, Jeff. And before we close out, we'll treat these next pair of questions as a lightning round, so to speak. And, Jason, we will allow our guest, Jeff, the final word. But, Jason, what's one thing we haven't touched on that concerns you? And then what would make you turn more positive at this time?
So I think just the risk that the measures that we're taking place will be effective, but then maybe the social restrictions are lifted perhaps too soon, and then we get kind of a flare-up again of the virus, in the second half of this year. So I think that's markets, I believe, are kind of pricing for a scenario where we take a hit in the next month or two, but things start to kind of normalize from there. If that turns out not to be the case, then there's certainly for equities sort of some more downside. So that's one thing that we haven't touched on. I think the thing that would get me sort of obviously more positive, by far would be signs that the virus is kind of coming under control, whether it's because of the social distancing measures, whether some of the efforts to get medical supplies to the healthcare providers accelerates, and other measures that could just at least get us comfortable that this is a risk that we understand it's out there, but we can kind of manage, and therefore we can start to kind of refunction society. And so if that sort of progresses over the next month or two, that would get me much more comfortable that this was a one-time hit, and then we can start to probably more accelerate in the second half of this year in terms of the outlook.
And Jeff Kilburg, same questions to you. One thing we haven't touched on that is of concern to you, and what would make you more positive at this time?
Well, Jason hit the nail on the head, and it's that next wave of COVID-19. If we don't have a treatment or a vaccine by November, next flu season, I do have concern about that. What will turn me positive, Daniel? Well, I think if we see, it was nice to see Dr. Fauci came out today, talked about glimmers on the horizon due to the fact that the social distancing is being adhered to, and that is going to potentially help the numbers in the short term. But I also think, there's other things that you have to realize. Is there a potential uptick rule be implemented? I know the SEC was on CNBC yesterday talking about that. So are some mechanisms that could turn me more positive, but I also rely on technicals. If we see this market settle twice above 2,700, that's going to really make a lot of the folks who raise cash down at 2,400 rethink about their asset allocation and being invested in the market. So I think there's a couple things to consider to make me more positive, but I think that commitment by the Federal Reserve in unlimited capacity and perpetuity, that makes me positive and puts a smile on my face.
Well, Jeff Kilburg and Jason Draho, terrific and timely insights. I know we covered a lot of ground over the past 30 minutes, but value-add insights for financial advisors and their clients. So great catching up with you both. I know this topic is very fluid, so perhaps look forward to having some follow-up conversations with you both in the not-too-distant future.
Thanks, Daniel. Thanks, Jason. You were awesome.
Well, thank you, Jeff, for joining us today, and stay safe.
And again, we've been joined by Jeff Kilburg, the founder and chief executive officer of KKM Financial, as well as Jason Draho, the chief investment officer's head of asset allocation Americas. We will have a full replay of this segment up on our call bank for you in a few short moments in case you missed any part of it. Do stay tuned. Coming up in 30 seconds, we will be back for you with a special capital markets update from our partners over at Credit Sites, and that will be led by Steve Cantor from the Fixed Income Solutions Desk. That call's coming up for you in about 30 seconds. Do stay tuned.